My name is Alex Morgan, and welcome back. If you are new here, this is where we break down markets, precious metals, and macro trends using real data, plain language, and zero fluff. Hit that subscribe button right now if you haven't already, ring that notification bell, and drop a like on this video. It helps more than you know, and it tells me to keep making content like this for you. Now, let's get into it, because what I'm about to show you is one of the most alarming and underreported data stories in the entire precious metals market right now. The silver warehouses in Shanghai, the ones managed by the Shanghai Futures Exchange, the largest futures exchange in all of China, are nearly empty. Not low, not just below average, nearly empty. As of the most recent data I pulled this week, those warehouses are holding approximately 423 tons of silver. Let me put that number into context for you because it sounds big until you understand what it used to be. The daily average since the SHFE began tracking this data back in 2012 is 1,138 tons. The all-time peak was hit on January 12, 2021, when warehouses held 3,091 tons of physical silver. So right now, we are sitting at roughly 37% of the long-term daily average, and compared to that 2021 peak, we have lost 86% of the inventory. 86%. That is not a market trending lower, that is a market that has been drained. And today, I want to walk you through exactly what that means, where this drain came from, what the consequences are being felt right now across global markets, and most importantly, what happens next before April 2026. Let's start from the very beginning, because understanding how we got here is essential to understanding where we are going. For the past 5 years running, the global silver market has operated at a structural supply deficit. That means the world consumed more silver than it produced every single year from 2021 through 2025. The Silver Institute, the most authoritative tracking body for global silver data, has confirmed 5 consecutive years of this deficit. Their forecast for 2026 puts the shortfall at approximately 67 million ounces for the year. And those missing ounces have to come from somewhere. They come from above-ground stockpiles. They come from warehouses. They come from exchange-registered vaults. They come from exactly the kind of storage that the Shanghai Futures Exchange tracks every single day. So when you watch SHFE silver inventories drop from 3,091 tons in January 2021 down to 423 tons today, you are watching 5 years of cumulative deficit physically manifest in the form of empty shelves in Chinese warehouses. Now here is where it gets complicated in the most interesting way, because the inventory drain in Shanghai did not happen in isolation. This is a global phenomenon hitting multiple markets at the same exact time, which is something that genuinely has not happened before at this scale. COMEX, the commodity exchange in New York, which is the primary price discovery hub for silver futures in the Western world, has seen its registered inventory collapse by over 70% from its 2020 peak. In the first 2 weeks of January 2026 alone, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX warehouses. That means roughly 26% of COMEX's registered inventory disappeared in a single week. Meanwhile, London's LBMA vault holdings, the backbone of the global wholesale silver market, have fallen approximately 40% from their recent highs. When you overlay the Shanghai drawdown on top of the COMEX and LBMA drawdowns and look at them together, you are looking at a simultaneous depletion of all 3 of the world's major physical silver storage hubs at the same time. The last time something remotely like this happened was 1980, during the Hunt brothers' attempt to corner the silver market. And even then, the stress was more localized to one exchange. What caused this in Shanghai specifically? There are 3 main drivers, and they stack on top of each other in a way that creates compounding pressure. The first driver is industrial demand. China is the world's largest consumer of silver for industrial use, and the single biggest category of that consumption is solar panel manufacturing. Each solar panel contains silver, specifically in the conductive paste used on photovoltaic cells. China has been building solar capacity at a rate that has no historical parallel. Global solar installations have been growing by double-digit percentages annually, and China has led that build-out. The PV manufacturing sector alone consumed approximately 232 million ounces of silver globally in 2024. That is a 5-fold increase from 2015 levels. In 2026, even as some major Chinese solar manufacturers are beginning to test copper-based alternatives, companies like LONGi and Jinko Solar have both signaled plans to move toward copper metallization in their cells. The substitution is technically difficult and will not happen at scale before this summer at the earliest. So for the period we are focused on, meaning now through April 2026, Chinese solar manufacturing is still a massive and active consumer of physical silver that is being withdrawn from exchange warehouses on a continuous basis. The second driver is investment and wealth preservation demand. In 2025, China introduced new tax regulations on gold transactions that significantly increased the friction of using gold as a wealth preservation vehicle for many Chinese merchants and retail investors. The response was a pivot, a large-scale shift from gold into silver as the preferred store of value. This pivot happened quickly and at scale, and it created what analysts have described as a dual supply shock. You had industrial buyers withdrawing silver from SHFE warehouses for manufacturing, and simultaneously you had investment buyers withdrawing silver from those same warehouses for wealth storage. Both types of demand pulling from the same pool of physical metal at the same time. The third driver is China's export licensing regime, which was introduced in 2026 and has fundamentally restructured how silver flows out of China into global markets. Under the new framework, only 44 companies have been approved to export silver during the 2026 to 2027 period. The qualifying criteria for approval are strict. A company must have annual silver production capacity of at least 80 tons and must carry a minimum $30 million credit line. The result of these requirements is that approximately 95% of historical silver export participants in China have been cut off. Industry analysts estimate that this could reduce China's refined silver exports by 30 to 50% compared to 2025 levels, creating a shortfall of roughly 2,000 tons for Western buyers who previously sourced processed silver from Chinese refiners. China does not dominate global primary silver mining. It accounts for roughly 13% of that, but it dominates global silver refining capacity, and that distinction is critical. The restrictions are on refined silver flowing out, not raw ore in the ground. So even if other countries are mining silver, the bottleneck is at the processing and refining stage, where China has decisive control. Elon Musk recognized the significance of this development almost immediately. When the controls were announced, his direct response was, "This is not good. Silver is needed in many industrial processes." That's a pretty remarkable signal when one of the most plugged-in industrialists on the planet flags a commodity supply disruption in plain language. Now let's talk about what the inventory situation in Shanghai is actually doing to prices in real time, and why the story is more complex than just looking at the Shanghai Futures Exchange silver price. As of this recording on February 24, 2026, the silver spot price in China is approximately 603 yuan per ounce, which translates to roughly $87.51 US dollars. That is a significant recovery from the crash lows we saw at the end of January, when silver plunged nearly 35% in under 48 hours after a combination of hawkish Federal Reserve Chair nomination news, CME margin hikes, and forced speculative liquidations hit the market simultaneously. The all-time high in Shanghai was 811 yuan per ounce, reached on January 28, 2026, equivalent to about $111 USDs at the time. But here is the thing about that price, and about any price you see quoted for silver right now. The paper price and the physical price are increasingly telling different stories. This divergence is one of the most important dynamics in the current silver market, and one that the mainstream financial media largely fails to explain properly. The global paper silver market, meaning futures contracts traded on COMEX and the SHFE that represent promises to deliver silver in the future, operates at an enormous multiple compared to the actual physical metal available for delivery. At various points in early 2026, the ratio of outstanding paper-silver contracts to actual physical ounces that could be delivered against those contracts reached as high as 356 to 1. 356 paper ounces for every 1 real ounce sitting in a vault. This system has functioned for decades because the assumption always was that the vast majority of futures contract holders would close out their positions before expiration and accept cash settlement rather than demand physical delivery. In January 2026, that assumption started to break down in a meaningful way. When large numbers of holders began demanding physical delivery simultaneously, which is exactly what we saw in those COMEX data points showing 33 million ounces withdrawn in a single week, the paper market came under stress in a way that forced the CME to raise margin requirements multiple times within days. Shanghai did the same thing, hiking margin requirements and barring 16 clients from opening new positions. Those forced liquidations amplified the late January price crash far beyond what any single piece of news could have caused on its own. But here is the critical insight. Even during that paper market crash, the physical market in China was telling a completely different story. While COMEX futures were trading in the 60s and 70s during the worst of the sell-off, physical silver in Shanghai's spot markets was still commanding prices well above 90 to 110 US dollars per ounce. The Shenzhen Shuibei gold market was showing similar premiums. The Shanghai Futures Exchange itself moved into backwardation, a condition where the spot price trades above the futures price, which is a textbook signal of acute short-term physical tightness. The last time silver backwardation of that magnitude occurred was 1980. Think about how significant that statement is. When the physical price and the paper price diverge this dramatically, it tells you something fundamental about what is happening beneath the surface of the market. It tells you that there are people and institutions who actually need physical silver. Not the financial promise of silver, but actual metal in actual vaults. And they are willing to pay significantly more than the futures price to get it. Those buyers include solar manufacturers in China who need silver paste to keep their production lines running. They include electronics companies. They include investors who have concluded that holding a paper claim on silver inside a system with a 356-to-1 leverage ratio carries more risk than it used to. What does the SHFE warehouse inventory level signal about where we go from here? Analysts look at several interrelated signals. The key one is the relationship between falling inventory and price behavior. When inventory falls while prices rise, it typically indicates genuine physical demand is driving the market, not just speculative positioning. When inventory falls during a price crash, it tells you the crash is primarily a paper market event driven by forced liquidation, while physical demand remained intact. That is exactly what happened in late January 2026. Shanghai warehouses continued to drain even as the futures price was collapsing. Physical buyers were still taking delivery. Industrial users were still pulling metal. That divergence is a powerful signal about the structural strength of underlying demand, regardless of what paper traders are doing on any given day. So what happens next? Let's get specific about the scenarios playing out between now and April 2026, because that is what you are actually here for. The most critical threshold to watch in the SHFE data is the 350-ton level. The current inventory of 423 tons is already deeply depressed by historical standards, but most market observers have identified approximately 350 tons as the point at which the physical squeeze begins to create visible supply disruptions for industrial buyers in China. If SHFE silver inventory falls through 350 tons, the practical consequences become very concrete. Manufacturers start competing more aggressively for available spot metal. Premiums in the Shanghai physical market widen further versus COMEX futures prices, and the delivery risk for futures contracts settling in Shanghai rises meaningfully. At that point, the exchange has to make difficult choices about margin requirements, position limits, and delivery terms, choices that historically create significant price volatility in both directions. Given the current pace of withdrawal from SHFE warehouses, the shift from 449 tons on February 3rd to 423 tons on February 4th represents a decline of roughly 26 tons in a single day's reporting period. If that pace of withdrawal continues at even half that rate on average, the 350-ton threshold could be reached within the next 4 to 6 weeks, putting us squarely in the March to April 2026 window. That timing alignment is not accidental. It corresponds with the rollover period for major futures contracts, which always introduces heightened delivery demand. On the macro side, the Federal Reserve path matters enormously. Markets are currently pricing in roughly 60 basis points of rate cuts by year-end 2026, with the first cut not expected until June. That timeline is a headwind for silver in the near term. If you believe the current consensus, the Fed stays tight through spring, the dollar stays relatively supported, and silver's rally back toward $100 encounters resistance. Gold Silver's lead analyst Alan Hibbard has gone on record expecting silver to trade above $100 in 2026 as supply deficits deepen. FX Empire's technical analysis points to $100 as the next major target, with a break above that potentially opening the path toward $250 to $300 in a longer-term move. On the bearish side, some algorithmic forecast models are pointing to silver potentially pulling back to the high 70s in the near term before any renewed advance. What I find most compelling when I look at all the data together is this. The physical market is screaming shortage, while the paper market is still processing the shock of January's crash. Those two things cannot coexist indefinitely. Either the physical squeeze eases, through new mine supply coming online, through China expanding its export licensing, or through manufacturers successfully substituting copper for silver in solar applications, or the physical reality eventually forces the paper market to reprice higher. And given the structural dynamics we have discussed, the probability that physical supply eases materially before April 2026 is very low. New mines take years to bring online. China's export licensing appears to be a deliberate strategic policy, not a short-term administrative hiccup. And Longyi's copper-based production launch is targeted for Q2 at the earliest, meaning it has zero impact on silver demand before April. For the silver price direction specifically between now and April, I would frame it this way. The recovery from the January crash lows back into the upper 80s and approaching $90 that we have seen in February represents the first wave of recognition that the sell-off overcorrected relative to the physical fundamentals. The next test is whether silver can sustain above $90 and push toward $100. That move requires one of three catalysts, or some combination of them. A dovish surprise from the Federal Reserve in March that shifts rate cut expectations forward, a geopolitical escalation that pushes safe haven buying into metals, or a visible and data-confirmed drop in SHFE inventory through the 350-ton threshold that forces institutional recognition of the physical squeeze. Any one of those catalysts, landing on a market where leveraged short positions are already under stress and where the physical-to-paper divergence is already at historically extreme levels, could produce a very sharp and fast move higher. For the broader silver market, meaning mining equities, silver ETFs, and related assets, the inventory story in Shanghai is the single most important leading indicator right now. Companies like Hecla Mining, Pan American Silver, and First Majestic Silver carry significant operational leverage to silver prices. A move from $87 to $110 in the spot price doesn't just increase revenue proportionally. Because their production costs are largely fixed, the earnings leverage is multiplied. That is why in a genuine silver bull run, quality mining stocks often outperform the metal itself by a substantial margin. Let me leave you with the big picture here because I think this matters beyond just the trade. What is happening in Shanghai's silver warehouses is a symptom of something much larger. We are watching the collision between decades of underinvestment in physical commodity supply infrastructure and an explosion in demand driven by electrification, green energy, artificial intelligence hardware, and the simultaneous rediscovery of silver as a monetary asset in an era of fiat currency uncertainty. The world built a global pricing system for silver where 356 paper ounces circulate for every 1 real ounce. That system worked when nobody ever called the bluff. In 2026, people are calling the bluff. And the nearly empty warehouses in Shanghai are the most visible evidence of exactly that reality. Whether silver goes to $77 or $110 before April depends on short-term factors that none of us can predict with certainty. What I can tell you with confidence, based on the data we have reviewed today, is that the structural floor under silver is far more solid right now than it has been at any point in the last decade. The deficit is real. The inventory drain is real. The export controls are real. The industrial demand is real. Markets can ignore fundamentals for a remarkably long time, but they cannot ignore empty warehouses forever. Stay tuned. I will be posting updated SHFE inventory data and price analysis throughout March and into April as this situation develops. If you want to be there for every update, the subscribe button is right below this video. Ring the notification bell. Drop a like if this gave you value. And if there is a specific angle of this story, whether it is the COMEX delivery dynamics, the mining stock leverage play, or the gold to silver ratio trade, let me know in the comments and I'll build a dedicated video around it. This is Alex Morgan. Nothing in this video is financial advice. Do your own research, understand your own risk tolerance, and I'll see you in the next one.